Welcome back to AgJohn's Silver Update. Something unusual is happening in the silver market, and it is quietly catching the attention of experienced traders around the world. While many investors are focused on daily price swings, a much bigger story is unfolding behind the scenes. The real battle is no longer just about charts or paper contracts, it is about physical silver, where demand is beginning to outweigh available supply in one of the world's most important markets. One of the clearest signals comes from China. Buyers there have consistently been paying noticeably more for physical silver than the prices quoted on major Western exchanges. This is not a random event or a temporary market glitch. When premiums stay elevated for weeks instead of days, it usually means real buyers are competing for limited metal. That is a sign of genuine demand, not short-term speculation. Instead of focusing on today's exact silver price, which can change by the time you watch this video, it is more important to understand the forces driving the market. The direction of money, the movement of physical metal, and the balance between supply and demand tell a much bigger story than any single price quote ever could. As we go through today's analysis, we will connect several important pieces of the puzzle. We'll look at China's growing appetite for silver, the changing inventory levels inside COMEX warehouses, industrial demand from sectors like solar energy and electronics, and the technical signals that many professional traders are closely monitoring. Let's begin with China, because this is where much of the current momentum is coming from. The country's two major precious metals exchanges continue to provide valuable insight into real-world demand. Over the past year, premiums for physical silver have gradually expanded, showing that manufacturers and investors are willing to pay above international benchmark prices simply to secure supply. Why does this matter? Because premiums only rise when physical metal becomes harder to obtain. A short-lived premium can happen because of transportation delays or temporary supply disruptions. But when higher prices remain in place for an extended period, it usually reflects a deeper imbalance between supply and demand. China is by far one of the largest consumers of industrial silver. Its massive solar panel industry, advanced electronics manufacturing, and rapidly growing electric vehicle sector all rely heavily on this metal. Every new solar installation, every electronic component, and every EV requires silver in some form. As these industries continue expanding, the need for physical silver grows alongside them. Recent import figures also support this trend. Large amounts of silver continue flowing into China from mining regions and storage vaults around the world. More importantly, some of that metal is leaving Western vaults to satisfy Eastern demand. This creates an important opportunity for traders. When silver sells at a premium in Shanghai compared to London or New York, moving physical bars across markets becomes profitable. As a result, actual silver, not just paper contracts, is steadily shifting from west to east. This is where the conversation naturally leads to COMEX. Warehouse inventories have become one of the most closely watched indicators in the precious metals market. Unlike the excitement surrounding the retail buying frenzy a few years ago, today's inventory changes appear to be driven by genuine industrial demand rather than speculation. That distinction could become increasingly important as the silver market continues to evolve. To understand why these inventory numbers matter, it helps to know how the COMEX system works. Silver stored in COMEX-approved vaults is generally divided into two categories. Registered silver is available to satisfy futures contract deliveries, while eligible silver meets exchange standards but has not been designated for delivery. Both categories are important, but traders pay especially close attention to registered inventories because they represent the metal that can be delivered if contract holders request it. Over recent months, registered silver stocks have gradually moved lower. It has not been a sudden collapse or a dramatic headline-making event. Instead, it has been a slow and steady decline that has continued week after week. These gradual changes often receive little public attention, yet they can reveal far more about the market than a single day's price movement. When overall inventories shrink, confidence naturally shifts toward the physical side of the market. Futures trading depends on the assumption that sufficient metal is available if delivery is requested. As inventories tighten, investors begin watching the relationship between outstanding paper contracts and the amount of registered silver much more closely. That balance has become noticeably tighter than it was a year ago, suggesting there are now more paper claims competing for each available ounce. This does not automatically signal a crisis, but it does create conditions that tend to favor higher prices if demand continues increasing. Should more contract holders decide to take physical delivery instead of simply closing their positions, the available cushion becomes much smaller than it once was. China's persistent premium plays an important role here. Every shipment of silver moving from Western vaults into Asian markets gradually reduces the amount remaining inside COMEX warehouses. One shipment may seem insignificant, but over months the cumulative effect becomes much more meaningful. Like water slowly reshaping a riverbank, these steady outflows can eventually change the structure of the market. Another reason many investors remain optimistic about silver is its unique position among precious metals. Gold is primarily viewed as a monetary asset and a store of value. Silver certainly shares those qualities, but it also serves an essential role in modern industry. That combination gives silver a demand profile unlike almost any other commodity. Industrial consumption has continued reaching new highs. Solar energy remains one of the biggest drivers, with manufacturers requiring enormous quantities of silver for photovoltaic cells because of its unmatched electrical conductivity. Although engineers continue reducing the amount of silver used in each individual panel, overall production is growing so rapidly that total silver demand continues rising year after year. The same trend extends well beyond renewable energy. Electric vehicles require substantially more silver than conventional gasoline-powered cars. Advanced electronics, 5G communication equipment, artificial intelligence infrastructure, aerospace technology, medical devices, and military applications all rely on silver's exceptional conductive and antimicrobial properties. Every one of these expanding industries adds another layer of demand to an already tightening market. While demand keeps climbing, supply has struggled to respond at the same pace. Global mine production has remained relatively stable, and recycling alone has not been enough to close the gap. As a result, the silver market has experienced several consecutive years in which total demand has exceeded available supply. Unlike many other commodities, silver production cannot simply increase because prices rise. Most of the world's silver is produced as a byproduct of mining copper, zinc, lead, and gold, rather than from dedicated silver mines. That means output depends largely on the economics of other metals, not silver itself. Even when prices become more attractive, bringing a new mine into production often requires many years of permitting, financing, construction, and development. This structural imbalance between growing industrial demand and relatively inflexible supply is one of the strongest long-term arguments supporting silver. It does not guarantee immediate price gains, but it creates a foundation that many experienced investors believe deserves very close attention as the market continues to evolve. Another indicator that experienced investors continue watching is the gold-to-silver ratio. This ratio simply measures how many ounces of silver are needed to equal the value of 1 ounce of gold. Throughout history, the number has moved in cycles. When the ratio climbs well above its long-term average, many analysts believe silver has become undervalued compared to gold. When it falls sharply, silver is generally seen as relatively expensive. Over the past year, gold has significantly outperformed silver, supported by central bank purchases, geopolitical uncertainty, and concerns about the global economy. Silver moved higher as well, but not with the same strength, leaving the ratio elevated. Recently, however, that gap has started narrowing. Silver has begun showing signs of catching up, and historically, once that process gains momentum, silver has often delivered stronger percentage moves than gold. Many investors believe gold usually leads the precious metals sector, while silver follows later. Gold often reacts first to monetary uncertainty, inflation concerns, and financial stress. Silver tends to join the rally after confidence begins spreading throughout the broader precious metals market. That possibility is one reason optimism around silver has been increasing. The broader economic environment may also become an important factor. Markets continue watching the path of interest rates closely. When expectations shift toward lower rates, assets like silver generally become more attractive because they do not compete directly with high-yielding cash investments. Falling real interest rates have historically created supportive conditions for precious metals, and many investors are monitoring central bank policy for clues about where markets could head next. At the same time, governments around the world continue running large fiscal deficits while central banks have been steadily increasing their gold reserves. These purchases suggest that many institutions are looking for additional protection against long-term financial uncertainty. Although central banks buy gold rather than silver, stronger interest across the precious metals sector often benefits both markets. The technical picture has also started drawing attention. Instead of racing higher in a straight line, silver has spent months consolidating within a broad upward trend. Many traders view this type of price action as a healthy pause that allows the market to build a stronger foundation before its next major move. Several widely followed indicators remain constructive. Longer-term moving averages continue supporting the overall trend. Buying volume has generally been stronger during rallies than during pullbacks, and momentum indicators suggest silver is not yet in an overbought condition. None of these signals guarantee higher prices, but together they paint a picture of a market that remains technically healthy. On longer-term charts, the pattern becomes even more encouraging. Since forming its major lows, silver has consistently produced higher lows and gradually pushed beyond previous highs. That is one of the classic characteristics of an established uptrend. Of course, technical analysis is never a prediction. Unexpected economic events, a stronger US dollar, or weakening industrial activity could easily change market direction. Charts simply help investors understand current probabilities rather than promise future outcomes. Perhaps the biggest shift taking place is the movement of physical silver itself. For decades, pricing power was centered primarily in London and New York, but physical metal has increasingly been flowing toward Asia. China continues importing large quantities for manufacturing, while India remains one of the world's largest buyers for both investment and industrial purposes. Once silver enters factories, solar panels, electronics, or long-term private holdings, much of it does not quickly return to Western markets. That steady migration gradually reduces the pool of readily available silver supporting Western exchanges. Combined with strong industrial demand, tighter inventories, improving technical conditions, and changing macroeconomic expectations, it helps explain why many long-term investors believe the silver market is becoming increasingly interesting as these trends continue developing.